Hi everyone, welcome back to Mortgage Breakdown. If mortgages feel confusing, you're in the right place. Today we're comparing FHA loans and conventional loans, and by the end you'll have a clear idea of which might be better for you. Let's start simple. FHA loans are backed by the Federal Housing Administration. They're designed for first-time buyers or people with lower credit, and they make home ownership possible with smaller down payments. Conventional loans, on the other hand, aren't government-backed. They follow rules set by Fannie Mae and Freddie Mac. That usually means stronger credit requirements and larger down payments. One of the biggest differences between FHA and conventional is the down payment. FHA lets you put down as little as 3.5%. On a $300,000 home, that's about $10,500. Conventional loans usually start around 5%, so you'd need at least $15,000 down on that same home. Another thing to consider, a smaller down payment means a bigger loan balance. On FHA, you're borrowing $289,500 versus $285,000 with conventional. It might not seem like much, but over 30 years, that extra $4,500 financed means you're paying interest on top of interest. Even small differences at the start can add up big over time. But here's the trade-off. If you put less than 20% down, you'll pay PMI, private mortgage insurance, on both FHA and conventional. The difference is, conventional PMI can be removed once you build up 20% equity. FHA's insurance, much harder to get rid of. Let's put this side by side. On a $300,000 home, FHA with 3.5% down equals $10,500. A conventional loan with 5% down equals $15,000. Not a huge gap in the beginning, but the difference shows up monthly. FHA charges an upfront fee plus monthly mortgage insurance, usually for the life of the loan. Conventional PMI is often cheaper and eventually drops off. With conventional, you can often ask your lender to cancel PMI as soon as you hit 20% equity, and in some cases, it drops off automatically at 22%. With FHA, unless you put down at least 10%, the mortgage insurance usually lasts for the entire 30-year loan. That's a major difference if you plan to keep the house long term. It could mean thousands of dollars in extra costs. Here's another big difference: credit score. FHA is more forgiving. Many lenders will approve FHA loans with scores as low as 580. Conventional is stricter. Most lenders want to see at least a 620, and the very best rates go to people with credit scores of 740 or higher. Here's how that affects your payment. Say your score is 620. You'll probably qualify for both FHA and conventional, but on conventional, your interest rate could be a full percentage point higher than someone with a 740 score. That difference could add $200 or more to your monthly payment. And over the life of the loan, that's tens of thousands of dollars. FHA loans often advertise slightly lower interest rates compared to conventional. But here's the catch. Once you add in FHA's mortgage insurance, the total cost can actually be higher. What if FHA's interest rate looks lower on paper, but your monthly payment is still higher than a conventional loan once you add in insurance? That's why you can't just shop for the lowest rate. You need to compare the full monthly payment and the total long-term cost. So when is FHA the right choice? It's best if your credit score is on the lower side, your savings are limited, or you need more flexible qualification rules. FHA is a stepping stone into homeownership when you can't quite meet the conventional requirements. Another factor is how long you plan to stay in the home. If this is just a starter home and you're moving again in 5 to 7 years, FHA's lifetime insurance may not matter as much. But if this is your forever home, those ongoing costs really add up, and conventional could save you a lot more over the long run. Conventional is usually better if you've got stronger credit, stable income, and some savings. You'll have more options, you won't be stuck with long-term mortgage insurance, and your total costs are often lower over time. Here's what that looks like long term. On a $300,000 FHA loan, you might pay $200 to $300 a month in insurance every month for 30 years. That adds up to $70,000 or more. On a conventional loan, PMI might be $150 a month, but it could drop off in 5 to 7 years. That saves you tens of thousands of dollars over the life of the loan. And remember, it's not just the insurance. Because FHA often means a slightly higher loan balance, you'll also pay more interest over time compared to conventional. So the real gap between FHA and conventional may be much bigger than the PMI difference alone. Let's recap. FHA is easier to qualify, lower down payment, but has long-term insurance costs that can add up. A conventional loan means higher credit requirements, a slightly bigger down payment, but more flexibility and usually lower costs over time. So the choice really depends on your credit, your savings, and how long you plan to keep the home. If this was helpful, hit subscribe so you don't miss the next video, where we'll dive into PMI in detail and show exactly how it affects your payments. See you then.